Now, as we pivot to the refined products world, we want to look at where refined products sit right now. And here you can see that the current implied demand, again, looking at gasoline, jet, disti, and resid, is at 13.86 million barrels a day, and versus last week of 13.62. So we're still well below what is normal, where we typically trend a bit higher, and we get to about 14.5, 14.8 million barrels a day, and we still have failed to maintain an average trend closer to what we thought was going to happen of about 14.2. And the reason why is because gasoline came in a bit lighter than we expected, and the trucking, just never really resonated with some of these increases. And given the newest data that's come out, we don't see that trend changing, which is going to keep us fairly isolated and limited in some of those increases in general. So again, those are some of the problems that we continue to see. There are some of the issues that are continuing to move forward on a lot of different levels. And that's, again, these are some of those hesitancies and those problems that we continue to structure, we continue to fall down on. And that's where we see a lot of these uncertainties. So when we look at distillate, when we had a build of about 2.93 million barrels, we're still well below the 5-year average. We're right in close to where we were last year. But you can see that it's an unseasonable build. Typically we have some pretty steady draws that run straight through till April into early May. And the reason why that we had this build was imports. Imports were up 379,000 barrels a day, 307,000 barrels a day above the 5-year average. That, again, helped really solidify where you had the end to the cold snap. So you had some, now we're going to have some fairly elevated, warmer weather, and then we have these imports. So you have slowing demand on the diesel side, on the trucking side, you have slowing demand on the heating oil side. And now here you have your increase in imports, which created that unseasonable build. We're still going to get draws. That's still going to be the case. It's just you're going to see them soften out and actually not be as I think heavy as was earlier expected. And that's, going to be a problem when you start weighing in what kind of activity are we going to see on what kind of activity are we expecting, or what kind of activity are we going to see on some different levels regarding some of the different flows in the different pieces of really where are we going to where's demand going to end up. And I think that's the biggest issue when you look at where heating demand is and where diesel is, and that's where we see some of that flatlining until we get to the end of February, where we should get a little bit of a warmer, colder snap, which is going to help. But as diesel cracks come down, and here you can see they're at the lower end of the range, well, what does that mean for runs? What does that mean for the refiner, which is already struggling on the gasoline crack? And the distillate crack was the only thing really keeping things elevated. As the distillate crack comes down, are we going to see more pressure on margins? Are we going to see economic run cuts? We don't think we're going to get that in the U.S., but that's something that we see very likely happening and transpiring as we go into the international markets, as we look at Asia, as we look at some of those additional flows. So now when we look at distillate in general and you look at pad 1, we're starting to get some of these builds. Things are starting to rise in general. There are some of these additional benefits, but you're still at the low end. And a lot of this is because of imports. Imports fall away a bit. So we're still going to see draws. The question is, given how warm it's gotten, the draws will be a bit shallower. It's still going to be very much on the lower end, but not as aggressive as we saw last year, just given where the demand dynamics have shifted to. And here's when you look at pad 3, sizable build. It's just going to be a matter of where are exports going, because we know that, Colonial is essentially tapped out. How much goes into the Atlantic Basin? How much flows back and forth between the U.S. and Europe? And I think some of those key pieces are going to sit there. So then when we look at distillate products supplied in general, here you can see that things have fallen out of the 5-year average. As we've said before, we expect it to be below the 5-year average. We didn't expect it to be actually this week. We expected to be at the low end of the shaded line, but or the cloud rather, but just at the very low end. And I think that's something that's going to continue to happen as we go through the remainder few months. And here's one of the key reasons why. So container imports bound for the U.S. are below pre-COVID levels. And again, this is what's to come because these are inbound ocean TEU volumes index. So looking at what FreightWaves is saying, they're showing you what's to come. So once we work through what's already here, and it's not a lot, given where we ended the year, where we're picking up now, you can see that things are not all that great on the manufacturing side, on the consumer side, and that's going to weigh on the economy. That's going to weigh on spending. That's showing you that we are not in a good position. Where there's consumer-wise, we are just south of $1 trillion of credit card debt, with credit card interest rates being at a record high of just over 19.9%. And now when we look at where things are going, we continue to see these pressure points on the consumer, which is going to slow down spending, which is, again, going to keep this fairly depressed. So now when we look at the internet truck stop here, you can see the market demand index continuing to kind of flatline. We see it between that 42, 48. And just given what the FreightWaves is saying, where on the inbound side, things in January were fairly normal. But the drop off in February has been aggressive, and it's going to show more pressure coming forward and more pressure overall. So then when we look at U.S. rail traffic, you're continuing to see intermodal slow down. That's something that we think is going to continue or at least be a headwind. When you look at chemicals, same thing. Farm products, grains are going to continue to be elevated. Petroleum products, it's going to stay fairly strong just given the movements that need to happen between Pad 3, Pad 1 and Pad 2. But again, the chem side and intermodal side are going to continue to be a headwind. And then just following on what FreightWaves is showing, this is just looking at the berths of what's coming into the U.S. So you're seeing a continuous slowdown of previous weeks, previous year, another slowdown in terms of February 19th, February 28th. You're seeing that movement down, and there's really nothing to show. Vessels within 40 nautical miles, 0. There's that big slowdown, which is going to really showing that breakdown and some of those hindrances to underlying flows. U.S. outlook, 6-day temperature outlook, things are well above average. This is what we've talked about in terms of what really took down natural gas, what continues to hit into heating oil, where you're just not seeing a lot of this demand. You're seeing diesel come down, and that's putting more of a damper into some of these underlying pieces. So then when we look at gasoline stock builds, gasoline was a build of over 5 million barrels. That's still 13.4 million below the 5-year average. Pad 1, Pad 2, Pad 3, Pad 4 all had builds, small draw on Pad 5. But again, everything's fairly normal in general. Pad 2 is actually the biggest driver of the decline versus the 5-year of being 8 million below. Pad 1 closing that gap. And the reason why is because there was a massive increase of imports into into Pad 1. If you remember, we kept saying that we saw it coming, but it wasn't coming into the numbers. This is a bit of a makeup number. So an increase of 489,000 barrels a day, increase of the 5-year average of 363,000 barrels a day. So again, seeing some of these steady increases in general, there's a problem. And I think that there is a big piece of where things are going, how this is moving through. Then when we look at the data, we're not going to see this huge surge back to these highs of gasoline. It's on a storage level. There's not, the ARB is closed. We had some cargoes actually redirect away from New York Harbor just this week. So you're going to see the imports level off. And again, it's just going to level off some of the storage builds. But as you get that steep drop down that normally happens in March into April, we just don't see the drop happening the same way, which is why the comps are going to get easier. And that's when the storage situation is going to become a bit more normal. Now, blending components had a build of 5.93 million. That's much closer to the 5-year average of only being down 5.5 million. And that's what is, I think, showing you what's to come of additional builds, additional pressure on the gasoline front. So DOE blending components, when you look at inventory builds here, you had an increase of, on 2022 of some of these increases in general and some of these movements going up. Based on the slowdown in petrochemicals, the slowdowns in general, we do think that there's going to be a sizable build here. I think that there's going to be a move in general as we see these movements up. And that's where, I think some of these things are going to continue to show. So even though gasoline won't get to that level, we do think that blending components does get to that level. And a lot of that is just from the lack of demand in the petchem space, which is going to push back into the gasoline space. Gas Buddy showed a build of, an increase to about 8.3 million barrels a day. Just another increase in general. We don't see, it's slightly below what we had, in terms of where things are. They were closer to about 8.4 this cycle. We don't see too much of an update in terms of where they are as, the EIA and Gas Buddy kind of meet in the middle. Then when you look at what's happening around the world, you're seeing that Asia Pacific ex-China is bouncing back a bit, starting to get closer to 2019 levels. Europe is just below. And the U.S. is still a bit below those levels as well. So again, just you're just some of the normalization, but you're not seeing you're still below with the 2019 component. We should get a little bit closer, especially in North America, and it'll likely look closer to what is in Europe as China has bounced back above some of these levels. But this is going to be the headwind as in terms of how quickly can we see some of this pricing come down. You can see January had a lot of pricing appreciation in gasoline, a little bit less in diesel, but gasoline had about an 18% pop in pricing. We do expect this to come down a bit, but you're still seeing a lot of that stickiness in price, which is what we've talked about in terms of cost, in terms of where things sit in general. And I think that there's a lot of uncertainties and again, I think that leads to some of the problems that we're seeing and some of the concerns that we have on the inflationary data, and just how much is the consumer gonna consume, and what is driving season gonna look like? How should we factor that in? And when you look at the again, some of those bellwethers that we discussed in the and we'll discuss in the Econ show, and some of these pricing models, we continue to see some headwinds. When we look at the gasoline front here, you can see that there's a bit of a headwind in terms of the gasoline flows in general. We've seen some of the pressure points, and that's where we just don't see the demand snapping back to normal levels. It's going to stay a bit heavy. And again, weather factors into that. You had some inclement weather improved, so we will get a bump. It's still going to be well below what is normal for this time of year, and then it'll increase along seasonal norms. The seasonal norms are still there. It's still going to move higher. It's just when you look at where that move up is, it'll just be a bit more at a depressed level. Propane had a drop of 4.3 million barrels a day. That's still 13 million above the 5-year average. And you can see that the rate of change is on point for this time of year, but it's just at a much higher level. And given where production is, given where demand is, we don't see that really collapsing anywhere. Jet fuel had a build of 350,000 barrels. 5-year average still well off, but as you can see, we're still right within our confidence range for the fuel demand side. A bit on the higher end, that'll likely hold true, just given the fact that we've had some TSA checkpoints come back above 2019 levels, which is a net positive when you look at underlying flows. Euro continues to be a bit weaker, but you're still, kind of averaging out to something that is fairly strong. TSA passengers, you can see here, that nice move against what happened in 2019 and 2020. So we think things are going to continue along that path. And then Open Table is showing some of this, a bit of an uncertainty back and forth, averaging out to a small decline in the U.S. As we look at some of the food prices and some of these other issues, we think that's going to continue to progress and be an underlying headwind when you look at spending. And again, another level of pressure that we do expect. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into what's happening abroad and what is some of the Saudi cuts relating to, and how is that going to shake out going forward.